Gold isn't stopping you out because you're wrong. Gold doesn't stop you out because your read is wrong. Most of the time, your read is perfectly fine. You just clicked before the market had finished collecting the stops it needed, and the second it had them, it left without you. You know the feeling. You mark a level, price taps it, you get in, and 4 candles later, you're out for a loss. 10 minutes later, gold runs $60 in the exact direction you called. Right idea, wrong moment. That gap between being right and getting paid is what this video closes. So today I'm giving you the 5-step routine I run on XAUUSD. How I pick a direction, where I'm allowed to trade, what has to happen before I click, where I take profit, and how much I put on. No indicators, no paid tools, a bare chart, structure, and liquidity. What you're getting in the next 20 minutes. Here's the roadmap. First, why gold has to be handled differently from a normal currency pair with actual numbers, not vibes. Then the 5 steps. Then 2 worked examples at today's gold prices, so you see the framework applied rather than described. Stay to the second example, because there I took a setup that broke one of my own rules. It paid. That's exactly why it's dangerous. I'll show you the trade and explain why I'd score it 5 out of 10, even though it was green. That distinction separates a trader from a gambler with good luck. And be clear on what this is, a scalping framework. We are not trying to forecast the whole session. We are not trying to catch a $400 move from the first tick to the last. We're isolating the cleanest slice in the middle of a move, the part where the odds are stacked and the stop is small. Gold is a different animal. Respect the numbers. Let's kill a myth first. Gold is not a forex pair with a different ticker on it. As I record this, gold is trading around $4,060 an ounce. And over the previous week alone, it traveled between roughly $3,969 and $4,113. That's roughly $144 of range in 5 sessions on one instrument. Zoom out, and it's wilder. Gold printed an all-time high near 5,597 earlier this year and is down around 7.5% year to date, which means the lot size that feels comfortable on GBP USD can take a week of profit off you in a single 15-minute candle on gold. Same risk percentage, completely different position size. If you take one thing from this section, take that. The other thing to understand is why it moves like that. Gold isn't priced off one economy. It reacts to interest rate expectations, to inflation prints, to the dollar, to central bank buying, and to geopolitical stress. When several of those land in the same session, structure on a 15-minute chart can be rewritten in 20 minutes. So the philosophy for the rest of this video is simple, and I want you to say it out loud. Get in fast, get out faster. Gold rewards decisiveness at a good level and punishes hope at a bad one. Step 1, make H1 and M15 tell the same story. Step 1 is direction, and I only use 2 timeframes for it, the 1 hour and the 15-minute. The 1 hour tells me which side of the market I'm allowed to be on. The 15-minute tells me whether I'm allowed to be on it right now. Reading structure is mechanical, not artistic. In an uptrend, price makes a higher high, pulls back to a higher low, then takes out that high again. Every time it closes above the previous high, you've got a break of structure, and the buyers still own the chart. A change of character is the opposite. Price has been printing lower highs and lower lows, then it closes above the most recent lower high. That single close is the market telling you the sellers just lost control of the leg. Not that price will fly, just that the previous story ended. Now the filter that saves most of your money, both timeframes must agree. H1 bullish and M15 bullish, I hunt longs only. H1 bearish and M15 bearish, I hunt shorts only. H1 bullish but M15 bearish? I'm not confused. I'm just not trading. I'm waiting for the 15-minute to finish its pullback and rejoin the hourly. Misalignment isn't a signal to be clever. It's a signal to be bored. Every trader I know who blew an account on gold did it in a misaligned market, convinced they'd found the exact turning point. You don't need the turn. You need the middle. Step 2. Mark only 2 things: liquidity and zones. Step 2 is location. Once I know the direction, I need to know where I'm allowed to look, because direction without location is just an opinion, and I only mark 2 things on the chart. Thing 1. Liquidity. Strip away the jargon and it's just where orders are stacked, and most of those orders are stop losses. Under an obvious swing low sit the stops of every long who bought the last bounce. Equal highs and equal lows are the loudest of the lot because everyone drew the same line. That's the whole reason price runs at those levels. A large order needs someone on the other side, and the cheapest way to find that counterparty is to trigger a wall of stops. A triggered stop is a market order in the direction the big participant wants. Your stop is fuel, not a target. Thing 2. Zones. A zone is the origin of an aggressive move to the last candle or two before price left in a hurry. In an uptrend, those are demand zones, and I mark them from the base of the impulse. I take the 2 nearest ones below current price and ignore everything else on the chart. 2 zones, 2 liquidity pools. That's the entire markup, and it should take you under 3 minutes. If your chart looks like a plate of spaghetti, you haven't done analysis, you've built yourself a reason to trade anywhere. Now the part most people miss. A zone on its own is average. Liquidity on its own is average. What I actually want is a demand zone that has a pool of stops sitting just underneath it so price can dip below the obvious low, grab the fuel, and finish inside my zone. That overlap is the setup. Everything else is a maybe. Step 3. The boring step. Nobody actually does. Step 3. Do nothing. I'm serious. Once the markup is done, my job for the next hour or 3 is to not touch the mouse. No position is a position. It's the one that can't lose. Because here's what actually kills accounts. It isn't a bad strategy. It's a decent strategy, executed 40 minutes early on a candle that looked strong. Mid-chart entries have no defined risk. Your stop is arbitrary, so your size is arbitrary, so your result is arbitrary. So the rule is blunt. If price is not inside one of my 2 zones, there is no trade. It doesn't matter how bullish the candle looks. It doesn't matter that I've been watching for 2 hours and I'm bored. Boredom is not a signal. Quick one while we're here. If the framework's landing so far, A-like genuinely helps this channel reach traders who are still entering mid-chart. Right, back to it. Step 4. The entry model. Sweep, shift, trigger. Step 4 is where the money is made, so pay attention. Price has finally arrived in your zone. This is the moment 90% of traders click. Don't. Arriving at a zone is not a signal. It's an invitation to start watching properly. Condition 1. The sweep. I need price to trade below the obvious low inside, or just under my zone, and then close back above it. Not wick down and keep going. Dip under, take the stops, close back inside. That closed candle is the receipt that the stops were collected, and someone absorbed the selling. Condition 2. And this is the one you can choose. Confirmation. There are 2 ways to take this trade, and they suit different personalities, so I'll give you both honestly, including what each one costs you. Model A, the aggressive entry. You enter on the close of the sweep candle itself, with your stop just under that wick. The upside is a tiny stop, and therefore a big reward to risk, often 3 or 4 to 1. The cost is honest. You'll eat more false sweeps, where price dips, closes back, then simply carries on down. Model B, the confirmed entry. After the sweep, you wait for the 5 or 15-minute chart to close above its most recent lower high, a change of character. Then you wait for the pullback into the small zone that created that break, and you enter there, Fewer losers, cleaner logic, better sleep. The cost of Model B is equally honest. Sometimes gold sweeps and simply leaves. No pullback, no second chance, and you watch the whole move from the sidelines with a perfect analysis and no position. That's the trade-off. Certainty costs you entries. My advice, don't take both. Pick one, run it for 30 trades, and log the results. Traders who switch models midweek never build a sample size, so they never actually know what they're doing. They only know how the last 3 trades felt. Step 5. Exits that fit gold, not your ego. Step 5 is exits, and it's the half of trading nobody makes content about because it isn't exciting. It's also the half that decides whether your good entries ever turn into money. The stop first, because the stop defines everything else. It goes just below the low of the candle that swept the liquidity, plus a small buffer for spread and noise on gold. I'd give it a couple of dollars, not a couple of cents. That low is now protected. The stops beneath it have already been taken, so there's less reason for price to return there. Never place the stop at the round number. 4,000, 4,050, 4,100. Those are the levels everybody uses, which makes them the cheapest liquidity on the chart. If your stop is where everyone else's stop is, you've volunteered. Now, targets. Because this is a scalp, I take the nearest logical pool of liquidity, not the dream one. For a long, that means the most recent 15-minute swing high, the resting stops of the shorts. Price is strong there, and I want to be flat before it decides what to do next. You'll usually choose between the internal 15-minute high and the bigger hourly swing high. The far one looks better on a screenshot. The near one gets hit far more often. Over 100 trades, the boring target wins. 2 management rules. Then we move on. 1. I move to break even only once price has cleared the first minor high, never just because I'm up and nervous. 2. I use a time stop. If the trade hasn't done anything within 8 to 10, 15-minute candles, the reason I entered has expired, and I close it manually. A setup that stalls has usually failed quietly. Sizing gold without blowing up the 60-second maths. Let's do the maths, because this is where gold eats people. One standard lot of XAUUSD is 100 ounces, so a $1 move is $100. $10 of movement, a slow morning, is $1,000 a lot. Hold that number in your head. So you size from the stop, never from habit. Say the account is 10,000 and you risk 1%, which is $100. Your stop on this setup is $18 of gold. 100 divided by 18 is about 5.5 ounces, so roughly a 5/100ths lot. Not one lot, not half, 5/100ths. Run that formula every single time, and your position size changes with every trade, which is exactly the point. Fixed lot sizing on gold means your risk swings between 0.5% and 5% depending on where your stop happened to land. That's not a strategy. That's a random number generator attached to your account. One last thing on cost. Gold's spread widens fast around news and at the session rollover. If your stop is $18, a 50-cent spread is noise. If you're scalping with a $2 stop, that same spread is a quarter of your risk before you've even started. Know what you're paying. Worked. Example 1. The long from the 4020 demand zone. Right. 5 steps on one chart. These are illustrative levels around gold's current trading area, so follow the logic rather than the price. Step 1. The hourly has swept a low, near 3,970, reclaimed it, and closed above the last lower high. Structure has flipped. I'm a buyer only. Step 2. I mark the demand zone that produced that break. Call it 4,018 to 4,030. Then I look underneath it and find what I want to see. A pair of equal lows around 4,022, sitting right inside the top of that zone. Zone plus fuel. That's my window. Step 3. Nothing. Price is trading up near 4,075, and it looks strong, and every fiber of me wants to buy strength. I don't. Strength, at the top of a range, is the most expensive thing you can buy. I set an alert at 4,032 and walk away from the desk. 2 hours later, the alert fires. Price grinds down into the zone and then does exactly what we want. It spikes to 4,014, taking out both equal lows, and the 15-minute candle closes back at 4,026. Sweep confirmed. The stops are gone, and the sellers who chased that break are now trapped underneath me. Aggressive entry. I'm in at 4,028 on that close. Stop goes at 4,010, just under the wick, with a buffer $18 of risk. Target is the last clean 15-minute high at 4,092, $64 away. That's roughly 3.5 to 1 before I've managed a thing. Confirmed entry on the same chart, you'd have waited for the 5-minute to close above 4,038, then bought the pullback into 4,031. Slightly worse price, slightly bigger stop. But you had proof the buyers were in before you committed a penny. Both are valid. Neither is a coin flip. Position size, using our formula. $18 stop, $100 risk, 0.05 of a lot. Trade duration, about 90 minutes. And notice what I did not do. I did not predict the day. I did not call the low. And I did not need to be early. I needed one clean slice. Worked. Example 2. The trade I'd score 5 out of 10. Now, the one I promised you. Same instrument, opposite direction, and a lesson that's worth more than the first example. The hourly is bearish, lower highs, lower lows, pushing down from the 4,100 region. Textbook short conditions on the higher time frame. But the 15-minute is bullish. It's mid-pullback, printing higher lows into the supply zone. So by my own step 1, this is a misalignment, and I should be sitting on my hands until the 15-minute rolls over. I took it anyway, because the zone was pretty, and I'd been watching it all morning. The trade itself worked. Price pushed into 4,111, swept the previous high, closed back below. I shorted at 4,104 with a stop at 4,119, and took profit at 4,062. Green trade, under an hour, textbook screenshot. And it's still a 5 out of 10, because the entry was fine and the decision was not. Here's the thing about a profitable rule break. It doesn't teach you a lesson. It teaches you a habit. Do it 4 times and your rules quietly stop existing, and the 5th one lands in a session where gold runs $300 against you. There's a second confession in this trade. Midway through, price came back at me, and I very nearly widened the stop because my gut said the high would get swept before the drop. My gut happened to be right that day. It has also been catastrophically wrong, and the difference between those two outcomes is not skill, it's the day. So let me be direct, because a lot of channels won't. Never widen a stop. It's the only promise you made before you had money on the line, when you were the most objective version of yourself. Moving it isn't intuition, it's your position negotiating with you. Take the loss and take the next setup, when not to trade gold at all. This section will make you more money than any entry model, and it takes 90 seconds. Gold is a macro instrument. It prices interest rate expectations, inflation data, dollar strength, central bank demand, and geopolitical risk all at once, all day, which means structure is only valid until a headline overwrites it. Around inflation releases, rate decisions, and jobs numbers, your beautiful demand zone is a suggestion spreads widen. The sweep and reverse behavior breaks down, and price travels further in 3 minutes than in the previous 3 hours. My rule is simple. No new positions in the 15 minutes before or after a high-impact release, and if I'm already in one, I either take partial profit or flatten. You're not being cowardly. You're refusing to bet on a coin toss with a widened spread attached. Same goes for the dead hours. Gold mid-Asian session often drifts in a tight range with no real participation, and range-bound gold produces sweeps that lead nowhere. The London Open and the London-New York overlap are where the clean liquidity runs live. 3 habits that quietly end gold traders. 1. Sizing up after a loss. You take a 50-pound hit, you want it back this hour, and the next trade goes on at triple size. Gold is the worst possible market for that impulse, because the volatility means you don't get a slow bleed, you get one candle that removes a month. 2. Trading without a written plan. If the entry, the invalidation, the target, and the size aren't decided before you click, you'll decide them while the position is moving, and a moving position is the worst possible advisor. Write 4 lines before every trade. 4 lines. 3. No journal. If you can't tell me your win rate on Model A versus Model B, or which session you actually make money in, you're not running a strategy. You're running a mood. Screenshot every trade. Tag the model. Review on Sunday. That's the whole system. Your drill for this week. 20 reps. Don't take this framework live tomorrow. Do this instead. Open the replay tool on XAUUSD. Pick a random day from the last 3 months and hunt 20 setups using only the 5 steps. No live money. No pressure. No ego. For each one, log 5 fields. Were the time frames aligned? Did price reach a marked zone? Was there a sweep? Which model you used? And the result in R rather than pounds. R keeps you honest. A 2R loss is a 2R loss, whether it costs 20 or 200. After 20 reps, you'll know 2 things that no video can tell you. Which entry model actually fits your temperament, and how often you break your own alignment rule when you're bored. Both of those are worth more than another strategy. Recap and what to do next. Let's compress the whole thing into 5 lines. 1. Direction comes from the hourly. Permission comes from the 15-minute. And if they disagree, you don't trade. 2. Mark 2 zones and 2 liquidity pools, nothing else. 3. If price isn't in a zone, there is no trade. 4. The trigger is a sweep of the obvious low or high, followed by a close back inside. Then either the aggressive entry on that candle or the confirmed entry after a change of character and pullback. 5. Stop under the protected wick with a buffer. Target the nearest 15-minute pool and size from the stop so every trade risks the same 1%. And the sentence to keep after you close this video. Your stop loss is not being hunted because someone is watching you. It's being hunted because it's sitting in the most obvious place on the chart. Move your thinking one step behind the obvious, and gold becomes a very different market. If this changed how you look at a gold chart, subscribe and turn the bell on. I break down setups like this every week, and the next one goes deeper on reading the sweep candle itself. Drop a comment telling me whether you're a Model A or Model B trader. I read them all, and it shapes what I film next. Not financial advice. Trading carries risk. Manage your risk 1 to 2% per trade. Thanks for watching, and I'll see you in the next one.